As we head into the new week, the U.S. stock market is, of course, closed for the weekend. Today is Sunday, October 19th, 2025. This means we have a moment to pause and analyze the board before the bell rings again on Monday morning. Looking at 3M Co., trading under the ticker MMM, its last print at the closing bell on Friday, October 17th, was $152.67 per share. That was a positive close, finishing the day up about 0.83%, or $1.26. Now that is the critical first insight, because the expectation for many investors, especially those who might have checked their Robinhood app or SoFi Invest platform on Thursday night, was a story of weakness. The stock had closed Thursday's session down 1.34% at $151.41, and the narrative felt heavy. But the reality is that buyers stepped back in on Friday, defending that $151 level and pushing the stock back into the mid-152 range. This changes the immediate technical picture from one of a potential breakdown to one of tense consolidation. And the reason for this tension is perfectly clear. 3M is on deck to report its third quarter 2025 earnings this coming Tuesday, October 21st, before the market opens. That event is now the single most important factor driving this stock. And Friday's trading action was the market placing its final bets before the cards are revealed. The common belief about 3M stock is that it's a wounded giant, a relic of American industrial might that is now hopelessly bogged down. The narrative is dominated by two things: slowing growth and the crushing weight of litigation, specifically the Forever Chemicals or PFAS lawsuits. For years, the expectation has been that this is a value trap. You see the high dividend yield, you see the iconic name, you think you're getting a bargain, but the reality is that the legal liabilities create an overhang so large that it's nearly impossible to model. Many investors, particularly those using long-term automated Schwab intelligent portfolios or working with Fidelity Wealth Management, may have been systematically reducing their allocation to MMM, seeing it as an unacceptable risk. But the reality of what's happening right now is far more complex and dynamic than that simple bear thesis suggests. The real story isn't just about a company playing defense, it's a company in the midst of a radical and aggressive transformation, attempting to surgically remove its liabilities and its low-growth segments to unlock the high-margin innovation core that still exists. The tension is a race. Can 3M's new operational focus and strategic divestitures create value faster than the lawsuits can destroy it? Let's look at the recent trading. The stock has been in a tightening range. After hitting a recent high near $156 in early October, it pulled back, finding support around that 151 mark twice in the last week, once on Thursday, October 16th, and again briefly on Friday, the 17th, before it bounced. The volume on Friday was solid, at just under 4.5 million shares. This wasn't a panicked high-volume breakdown, it was an orderly test of a support level, which held. This suggests that while sellers are present, there are significant buyers willing to step in. And when we look at who those buyers are, the story gets even more interesting. Institutional ownership in 3M is massive, sitting at nearly 89% of the entire company. But the big players are not in agreement. Recent filings show a fascinating split. On one side, you have giants like BlackRock and Capital World investors who have been trimming their positions, seemingly validating the bear case. On the other side, you have JPMorgan and Norges Bank, which manages Norway's sovereign wealth fund. JPMorgan, in its most recent filing, reported a massive 50% increase in its holdings. Norges Bank upped its stake by over 68%. This isn't retail traders using the Robinhood stock trading platform to scalp a few dollars. This is some of the largest, most sophisticated capital in the world, managed through prime brokerage accounts at places like Fidelity and Interactive Brokers, placing billion-dollar bets on opposing outcomes. JPMorgan isn't buying that much 3M stock because it likes the dividend. It's buying because its analysis suggests the market has the reality wrong, and that the turnaround is not only real, but accelerating. So what is this new 3M that JPMorgan is betting on? The expectation is still Post-it notes and Scotch tape. The reality is that the company has already completed its largest ever transformation, the spin-off of its healthcare division into the independent publicly traded company Solventum back on April 1st, 2024. That move fundamentally reshaped the company. What's left is a more focused industrial conglomerate organized into three main segments: safety and industrial, transportation and electronics, and consumer. This is the company that makes the N95 respirators, advanced abrasives for manufacturing, and crucial components that go into electronics. When you buy Apple stock, you're also indirectly betting on 3M's ability to supply advanced films and adhesives for those iPhones. When you buy Nvidia stock, you're relying on 3M's specialized materials for cooling and insulating those high-performance data center chips. This is a high-tech materials science company, and under its relatively new CEO, William Brown, the mandate has been clear: streamline operations, boost R&D, and prune the portfolio. And that pruning may not be over. A very significant rumor surfaced just a couple of weeks ago, on October 4th, suggesting that 3M is now exploring the sale of billions of dollars in assets from its industrials arm, specifically targeting lower growth businesses. This is exactly the kind of aggressive move the bulls want to see. This all brings us back to Tuesday's earnings report. This will be the ultimate test of expectation versus reality. The consensus expectation is for earnings of around $2.10 or $2.11 on revenues of about $6.25 billion. That would be a respectable increase from the $1.98 they earned in the same quarter last year. But no one is just looking at the headline number. When 3M reported its Q2 results back in July, it beat expectations and, more importantly, raised its full-year guidance, signaling to the market that the operational turnaround was gaining traction. The stock popped on that news. Now the bar is set higher. The bulls need to see another beat and raise. They need confirmation that margins are expanding and that the new, leaner 3M is growing organically. But then there's the shadow. The bear case is entirely centered on the other side of the balance sheet, the liabilities. Any positive earnings news could be completely wiped out by a single sentence in the press release or a single answer in the Q&A about the PFAS litigation. Investors will be hanging on every word about the size of the legal reserves. Have they increased? Is there a new major settlement on the horizon? The company has already reached a multi-billion-dollar agreement with New Jersey back in May, but that is just one piece of a puzzle so large it's been compared to the asbestos litigation that bankrupted numerous companies. This is the core conflict. You have a potentially healthy, streamlining, high-margin industrial core on one side and a bottomless-looking legal pit on the other. This is why the stock is stuck in consolidation. It's why many retail investors who invest online are scared to touch it, while some of the world's biggest institutions are taking massive opposing positions. This stock isn't for those just looking for basic investment help or online investing 101. This is a complex, special situation play. So here's the question for everyone watching. This all comes down to the earnings call on Tuesday. What is the one number you are watching? Is it the EPS beat, the full-year guidance, or the size of the new PFAS legal reserve? Comment below with what matters most to you. Looking ahead, the scenarios are incredibly stark. In the bull scenario, 3M delivers a clean beat on earnings, raises its full-year guidance again, and, this is the key, gives a confident, stable update on the litigation front, implying the worst is quantified and manageable. If that happens, and if management even hints at the rumored industrial divestiture, the short sellers will be in a world of pain. We could see the stock break its 52-week high of $164.15 and make a run for $170. This would be the JP was right scenario, validating the thesis that the investment is in the new focused company. In the bear scenario, the earnings are fine, maybe just in line, but the company either lowers its full-year guidance, citing macroeconomic weakness, or it announces it's setting aside another several billion dollars for litigation. If that happens, the value trap thesis is proven correct. All the operational improvements will be shown to be